Hey everyone, Noah Zerby here. This is one of a series of short videos looking at the question of development and the challenges of inequality in the global polity. This video focuses in particular on the two key institutions dealing with development today, the International Monetary Fund and the World Bank. There's a lot to unpack, so let's get started. Both the International Monetary Fund and the World Bank were created at the 1944 Bretton Woods Conference. At the time, World War II was beginning to wind down, and the Allies were anxious to create a new international order that would help to rebuild Europe while also facilitating closer connections between countries to prevent another war. The system that was created at the Bretton Woods Conference centered on two key international institutions, underscored by the US dollar-based reserve system, which we considered in a different video. The International Monetary Fund would be responsible for providing short-term loans to aid countries in meeting balance of payments obligations. The primary purpose of the organization was thus to provide fiscal and exchange rate stability for the global economy. Today, the IMF has a total lending capacity of about $360 billion. The World Bank was established to directly aid in the reconstruction of Europe by providing longer-term development loans for member states. As Europe rebuilt and the former colonial states began to secure their independence, the World Bank shifted its focus to helping to achieve development in the global south. Today, the World Bank's official mission is to help reduce global poverty. The World Bank has a total lending capacity of about $52 billion, or about 1/7 that of the International Monetary Fund. Though we often talk about the World Bank as though it were a single organization, it is in fact comprised of 5 distinct organizations collectively operating under a broad umbrella. The International Bank for Reconstruction and Development offers loans to middle-income developing countries, generally to fund large-scale infrastructure projects, education, energy investments, healthcare projects, or other projects to expand, for example, food, water, and sanitation access. Established in 1960, the International Development Association is focused on the provision of concessional loans, that is, loans that offered below market interest rates, and grants to the world's poorest developing countries. The IDA's stated mission is to assist the poorest countries to quickly, equitably, and sustainably reduce poverty and to promote more rapid economic growth. Loans from the IDA are often used to fund programs like the provision of childhood immunizations, recruiting and training teachers, and on constructing infrastructure like the IBRD. Ideally, as countries develop, they're able to transition from the International Development Association into the International Bank for Reconstruction and Development. The International Finance Corporation provides investment advice and asset management services intended to encourage the expansion of private sector development in the global south. While technically a private corporation, the IFC's sole shareholders are its member states, who vote on decisions of the corporation in proportion to their monetary contributions to the organization. The IFC was established in 1956 and focuses exclusively on for-profit and commercial projects which help reduce poverty and promote development. Its primary focus includes agriculture, health and education, microfinance, and assisting small businesses. The Multilateral Investment Guarantee Agency was created in 1988 to help promote foreign direct investment into developing countries to support economic growth, reduce poverty, and improve people's lives. The MIGA focuses on countries that are part of the IDA and countries that are affected by armed conflict. The agency encourages foreign direct investment by providing insurance against political risk and by ensuring foreign investors' losses against governmental expropriation, war, terrorism, or other threats from political instability. And finally, the International Center for the Settlement of Investment Disputes was established in 1966 to provide a legal forum to resolve disputes between international investors. The ICSID can arbitrate disputes between governments and companies in an effort to reduce the level of political risk associated with investing in developing countries. Both the International Monetary Fund and the World Bank organizations are technically responsible to the member states, but this has generated some controversy. Both organizations employ weighted voting systems that give member states a number of votes equal to the share of the organization's budget they provide. In the International Monetary Fund, for example, a country's quota, you can think of these basically as dues, are determined primarily based on the size of the country's economy and the openness of the economy, the degree of economic stability in country, and the size of the country's foreign reserves. These are based on these figures, a country's quota is determined. The United States, for example, contributes about 16.5% of the IMF's total quota. This entitles the United States to 16.5% of the total votes in the IMF. The world's poorest countries, by contrast, may have as little as 3/100ths of a vote. The World Bank allocates votes through a similar mechanism. This has three important effects. First, because the IMF and the World Bank operate on the basis of a supermajority vote, the largest stakeholders like the United States and the European Union are effectively granted a veto over any decision of the organization. Second, because of their historical importance and influence, the United States and Europe have informally divided leadership of the two organizations between them. By tradition, the managing director of the International Monetary Fund has always been a European, and similarly the president of the World Bank by tradition has always been an American. Third, and perhaps most importantly, the voting system employed by both organizations means that countries that are most often subject to the policies established by the organization often have the least influence in crafting those policies. With its 16.5% of the IMF vote, the United States has more than twice the voting power and thus twice the influence of all 53 African member states of the IMF combined, which collectively share about 7% of the votes, roughly the same as the government of Japan. This means that developing countries in general are less able to influence the policies or agenda of the international financial institutions, even while they're disproportionately affected by those policies. Today, the International Monetary Fund's primary purpose is to maintain currency stability and to provide assistance to member states in meeting their balance of payments obligations. When a member state is unable to meet its international obligations, the IMF can provide emergency loans to allow them to continue to finance their operations. The most dramatic example of this occurs during financial crises or currency crises, such as those that occurred in Mexico in 1994, the Asian financial crisis of 1997, the Russian ruble crisis of 1998, and so on. In each of these crises, internal economic challenges combined with external pressure, particularly in the form of financial speculation, to spark crisis. Let's look at one of those in a bit more detail. In Russia in the summer of 1998, domestic political instability combined with economic stagnation and a speculative attack on the Russian ruble. The Russian government had been spending its foreign currency reserves to try and maintain the ruble in a narrow price band between 5.3 and 7.1 rubles to the dollar. Under this system, the Russian government would sell rubles if the price dropped below 5.3 to the dollar and would buy rubles if the price exceeded 7.1 to the dollar. When speculators began selling Russian rubles in 1998, they created a sharp downward pressure on the value of the ruble, reflected in this chart in an upward price number, meaning that it took more rubles to buy $1. The Russian government responded by buying rubles, selling dollars it had in reserves. As the Russian government ran out of dollars, it was forced to turn to the IMF for additional dollars, which it then used to buy more rubles in an attempt to maintain the value of its currency. However, because speculators had access to more currency than the Russian government did, the Russian government's policy was ultimately defeated and the value of the ruble collapsed. At the beginning of 1998, the ruble was trading at a rate of just under 5.1 to the US dollar. By January of 1999, it was trading at a rate of about 15 to 1. But remember that Russia had sold all of its dollars and had taken out somewhere between $5 and $17 billion in additional foreign loan obligations to defend the ruble. Like most debt taken on in the developing world, these were dollar-denominated obligations, which meant that they had to be repaid in US dollars. In an effort to maintain the value of the ruble, the Russian government used these dollars it had borrowed to purchase rubles, increasing demand for rubles. It buys rubles at an exchange rate of about 5 to 1 to the US dollar, so it now holds between 25 and 85 billion rubles. Unfortunately, the volume of speculative capital attacking the ruble far exceeds anything that the Russian government can defend against. The ruble thus collapses in value, falling from an exchange rate of about 5 to 1 to the US dollar to about 15 to 1 to the US dollar in a couple of months. By January, it's clear that the government's effort to defend the value of the ruble had been unsuccessful, but the Russian government still holds billions of dollars in rubles that it had purchased, but because the value of the ruble has declined so sharply, those rubles are now only worth between 300 million and 5 billion US dollars. And to make matters worse, because their international debt was priced in US dollars, the Russian government still owes the original loan amount to the creditors. They have between $300 million and $5 billion worth of rubles, but still owe between $5 and $17 billion to international lenders. Just how big a problem is currency speculation of the kind that collapsed the ruble in 1998? It's hard to get exact figures, but we have some approximations. Some 3.98 trillion in global currency transactions, usually abbreviated as FX, take place daily. To put that number in comparison, global annual foreign direct investment is somewhere in the neighborhood of $1.3 trillion. In other words, 3 times as much money is traded on global currency markets in a single day as flows in the form of investment between all the countries on Earth in a year. And just for the sake of comparison, the world's gross domestic product is estimated to be around $70 to $80 trillion. In other words, more currency moves through global foreign currency markets in less than a month than is produced in the entire planet in a given year. If we look at the annual rate of global currency transactions, we see how crazy this picture becomes. The vast majority of global currency transactions are speculative in nature. That is, investors are betting that the value of a particular currency will increase or decrease in the future and are making profits off of those fluctuations. Such transactions have no productive or consumptive component. Speculators are not buying or selling currencies as part of a broader economic transaction, such as investing in another country or purchasing oil on global markets. Rather, they're simply betting on small changes in the value of a particular currency. While such bets may provide liquidity to the market, that is, they help to ensure that there's a ready supply of buyers and sellers, they also have the effect of amplifying upwards and downwards trends or volatility in the market. In other words, their activity helps to create bubbles and busts. When countries are forced to turn to the International Monetary Fund for assistance, they're required to undertake certain structural reforms of their economies in exchange for the extension of lines of credit. These requirements are usually referred to as structural adjustment programs or conditionalities, even though that term was officially retired about 2002 and replaced with new programs known as poverty reduction strategy papers or poverty reduction and growth facilities. We examine the nature of those programs in a bit more detail in another video, but for now, for our purposes, just remember that they essentially require the liberalization of the country's economy and a sharp reduction in state spending and intervention in the economy. So that concludes our overview of the International Monetary Fund and the World Bank. If you have any questions, leave them in the comments section below, and thanks for watching. Have a good day, everyone.